couple years ago, these 3 letters popped up as the potential savior of crypto. Why did crypto need saving? Well, if you remember 2 years ago, FTX disaster, that's 3 letters, so we needed something else to supplant it. And we started hearing, if you've been following the space, the letters RWA quite a lot. Now, it turns out it's been in the market for quite some time. We're going to get into the history of this in just a minute. But it didn't seem to take off. In the past, it seems like there's been many failures in the RWA space, real-world assets that would use blockchain technology to tokenize, and then eventually, I guess, sold primary, initially, to investors, and then perhaps traded. And Carlos, you perhaps are the OG in this. So I do want to go and get a very quick snapshot of, if you can quickly, of kind of the history of tokenized real-world assets. Let's not talk about stablecoins just yet. We're going to be getting there.
So it was not called real-world assets when it started. It was called security tokens. That was started more or less in 2016 when people were doing a lot of ICOs, if you remember. And then people come up with a concept that an ICO is a token that is supposed to be a utility, and this is why it's not a security. If you issue a token that represents a real-world asset because you securitize the asset or you tokenize a security, a fund, equity in a company, etc., that's a security token. And that's when the industry started the whole concept of tokenization as a way to basically issue these securities in a more efficient way with a better ledger where people were...
This was the idea, the dream.
Correct. That was the idea back then. It didn't take off, as you know. I started my company in November 2017, and we launched in 2018. I'm probably the only survivor from that era. There were tons of companies. There were dedicated conferences talking only about security tokens and tokenization. And then it kind of died for a few years. And I think the reason it died was multi-pronged. It's not one single thing. First, the crypto people had an allergy to anything regulated for many years. So because they could do a lot of unregulated stuff that has less friction, and they were printing money doing that. So why would bother?
Carlos is the most anti-crypto person.
No. I'm just explaining what happened. So it's the reality, right? So if you could do an ICO where you didn't have to do KYC, where you could sell it to anybody you wanted, you didn't have to have a prospectus, you didn't have to have any sort of lockup periods, stuff like that, why would you bother?
All right. So the point is, you say it died because crypto people
crypto people have no interest. This RWA narrative has started the last couple of years. Then the second thing is the TradFi people, they didn't know whether this was legal or not. Because who tells you whether you can use this, distributed ledger technology to represent your security?
So there's a reputational hurdle.
Reputational, regulatory.
What about lastly on tech? Because Yuval, you've been building your organization, even before you had a name change, has been building essentially market structure starting there for what could be tokenized assets, including revolutionizing how stock exchanges could work. Maybe give us a quick history of kind of digital asset a little bit, and then how you guys have evolved into RWAs.
Yeah, I mean, for us, the focus was always RWAs because at the end of the day...
Before they were called RWAs.
I don't even think internally we call them RWAs today, but the idea is that, there's going to be limited Bitcoins or new asset classes that eventually will dominate capital markets, but there are still $300 trillion of assets that you can bring significant efficiency and bring them on chain.
That's pretty much like all financial markets combined.
Exactly. And it's not just bringing them for the sake of the asset itself. Is like if you look at eligible collateral today in TradFi, have about $100 trillion of eligible collateral. But because of the lack of velocity in those assets, which blockchain can provide, about only 25% of these assets get used. So if you actually think about it from a financial institution perspective, there's a significant opportunity to improve your return on capital if you can bring these assets on chain.
So let's get to that in a second. But I want to, yes, I'm glad we're framing kind of the size of the market here. We hear 300 trillion. And yet, I mean, Eric, seriously, how many assets are on chain right now? Like, again, I'm going to take away stablecoins. How much is the totality, roughly, of RWAs that exist out there?
I don't know.
I mean,
a trillion.
No, RWA is a trillion.
Maybe it's combined.
It's not even
hundreds of. I mean, stable coins are the big one.
Yes,
right?
No, certainly you're right. If we include stable coins, it's certainly a few hundred billion. But
so stable coins is 170 billion, and then actual assets that are real world assets, as people call them, so real stuff, not imaginary internet money, that are on chain, real blockchains, not projects announced, not people saying they've tokenized here and there, but it doesn't exist anywhere. My guess is there's less than 5 billion, maybe 5 to 10. And then
Yuval, would you agree with that number?
I think that if you look at permissionless chains, Carlos would be right. I think that if you start looking at the totality, because again, TradFi, to Carlos' point, due to the reputation risk, have been tokenizing assets, and you're going to see them moving from more of the permission chains to the public. I would say that the numbers are significantly larger.
Even more
Correct.
right now.
It depends what you mean by tokenization. Because if you have a database and you digitize an asset, and that database has one database which is slightly distributed because there's 3 or 4 nodes in a closed ecosystem, that's not really what the whole promise of tokenization is, right? That's
No, maybe not, but at least it's somewhere. Honestly, I'd argue it's an advance from where things have been in the past. And so, anyway, just to sum it all up, it sounds like there's between $5 and $10 billion of non-stablecoin based RWAs that are out there on permissionless blockchains, meaning the types of blockchains that we all know, Ethereum, et cetera. But Yuval says there's a lot more out there on permission chains, which are essentially private blockchains or distributed databases in reality, right? Is this
Correct.
more or less accurate?
That is correct.
And yet there's $300 billion in financial assets out there. Is that right? $300 trillion in financial assets out there that could be tokenized. Yeah, but why should they? Like, seriously.
But I think that's the killer use case that people are looking for. I think that's the real impediment here, is that instead of making tokenized assets a solution looking for a problem, there are problems that need to be solved that tokenized assets can solve. And I think you've all touched on it, which is the collateralization and making capital efficiencies. And I think most financial institutions care about capital and capital efficiency. And when they start considering how they can optimize around their capital, the movement of collateral turns out to be a huge unlock. And I'm so TradFi that when people say RWA, I think risk-weighted assets.
Yeah.
I don't know what this real-world asset is because all assets are real-world. What's a fake-world asset?
Yeah.
So
probably as opposed to before that they have fake assets. I don't know.
I don't want any fake assets. I only want real assets.
So, all right, let's talk about collateral, okay? So what do we mean by this? Yuval, if you can, try to break it down in terms of the way the flow is today in TradFi with collateral, and then how things could be different, might be different already, when it comes to tokenized collateral.
Super simple. CME today, if you want to trade futures, you need to post 2 types of instruments. When you put your position, you will put what you call initial margin. It's the initial margin that is required for you to put a derivative position. And every day, depending on market movements, you will fund your variation margin using cash. And as a result of the usage of cash, which is only available during banking hours, future markets don't accept collateral over the weekend, and therefore cannot offer 24/7 trading. So here's just a very basic example that if you allowed to tokenize all forms of collateral, and you can now post your initial margin and variation margin 24/7 on a permissionless blockchain, all future exchanges, all derivative exchanges would be able to operate 24/7. It's
So just that alone takes it from let's call it a 8-hour trading day, 9-hour trading day, 5 days a week?
8-5.
There's also other issues. In TradFi, if you want to post something that is not cash and you want to post a money market fund as collateral, you have to move the fund, right? Like move a unit of fund from one brokerage account to another one.
And that itself,
that is not
the
an
clearance
instant
settlement
process.
for that might take some time as well.
Correct. So this is just the databases they use, if you want, are not connected to each other, and then or they're not even open during the weekends, and then that makes the movement of whether it's money, tokenized money, or securities inefficient, right?
Okay, so it's super slow right now, even though it's 2025, and we're talking about.
But that was just a basic example for the audience. But if you actually now want to take a bigger problem, is there are what you call capital requirements for legal entities. So if you're a multinational entity like a bank or anybody else, and now you have a legal entity in Hong Kong and a legal entity in New York and a legal entity in different jurisdictions, you have those requirements in all of these jurisdictions. So back to Carlos' point, it's not just money market funds, but every asset takes time to travel between these destinations. But because you want to operate in all of these destinations, what do? You overcapitalize all of these legal entities so you can meet those obligations.
Yeah, it's kind of the only way. And this
honestly,
traps a lot of capital.
The crypto industry should understand it, because when crypto started, so when we at DRW were trading crypto in 2012 and 13, you had to capitalize all of the crypto exchanges with how much value you had. And then Tether came and said, No, actually, you can move US dollars 24/7 on chain.
All right, well, we'll get to stablecoins in a second.
But that is the exact example. That is collateral. That is the ability for me to move my assets everywhere in the world 24/7. Currently, financial institutions cannot do that, not just with cash, but with other instruments. So that is what Amar is talking about. The real opportunity is you could actually reduce your balance sheet to fund the same activity by probably 20% on
20%.
average. So just think about that from your return.
Just because the velocity of collateral movement
today
is
a
that
good
much faster.
bank good return on equity is anywhere like 10 to 15%. Like that's a good return on equity. Now imagine that they can fund the same activity with 20% less balance sheet. Just think about that. That is gigantic.
So you can do a multiple.
And we see, I mean, this is actually playing out in practice, right? Because we do have 24/7, 365 exchanges that trade derivatives. They happen to be in the crypto asset class because crypto is blockchain native. And because of that, we move collateral every 2 hours, right? I mean, that's the...
Yeah,
But
Eric,
there's not really a regulation that says you're not
Eric,
open
I
on
want
the
you to
weekend, right?
expand on
Convention, so.
kind of what
No,
we're seeing.
it's not the
Amar.
convention, sorry.
Eric, I want to find out, kind of what we're seeing in the crypto space right now, because we've heard kind of how it works in TradFi, and we've heard kind of some of the promise, via what we're seeing in crypto exchanges, crypto derivatives exchanges. But what else are we seeing in the crypto ecosystem?
Maybe just, if I can even add on to the other point, like there's the collateral efficiency point. There's also the power of a shared ledger. So when Lehman went bankrupt, for example, there was massive disputes after the fact that went on for years and years and years about the posting of collateral between New York entities and London. And it mattered because there was the bankruptcy was called at a specific time in the US, and depending on that, who should be the owner of the collateral? And you have different ledgers operating to different time zones on opposite sides of the Atlantic. And you sort of think about, like, if the liability to repay the cash and release the collateral, if these things were both on a shared ledger that's confirming transactions at the same time and recording information at the same time, you just wouldn't have that problem, which is even separate from the collateral efficiency point.
Yeah, completely.
That's why it's important to have a public blockchain, because for the ledger to be useful, it has to be a shared ledger that anybody can use. Because if you create like a closed ledger, even if you use a distributed database, then it doesn't really solve the problem. It only solves the problem for those specific market participants, more efficient definitely than what they do today. But if you want to solve like bigger problems, the ledger for the cash and for the securities should be tokenized in the same place for everybody to be able to interoperate with each other.
And yet, it probably should be private. I don't think that everyone in the world should see the same exact, every transaction from every financial institution. Wouldn't you say, Yuval?
I think you can add privacy at the public ledger. That's a different problem, right? But still the same ledger. So privacy is something that exists in public blockchains as well. So.
Well, sometimes it does.
Well, I mean, yeah, you can speak about it, but there's definitely
I think no different than the internet. The internet is a public network where everything coexists on the same protocol, yet you have the tools to make some of the information fully public, and you have the tools to make some of the information private. And I think that for us is the future of public chains, is this ability, as Carlos says, for everything to coexist on the same ledger. Is it timestamping? Is it composable transactions? There's a lot of benefits, but have the ability as an issuer, as a participant, to decide, do you want some information to be fully public or not? I mean, I will tell you that I think that and I know we're avoiding stablecoins, but if you can actually do transactions with stablecoins, I can tell you, we talked to a lot of corporations that are saying, I would love to use stablecoins. I would love to. I'm a publicly traded company. I cannot have the whole world. I cannot have Jonathan from Chainalysis be able to tell how many payments we have made and to who before my quarterly earnings, right? So I think that...
Sounds like an opportunity for new stablecoins, but...
The public internet symbol is a pretty good one. Imagine if the SMTP, which is the protocol for email, only work for silos. Like you and I can email, but he can only email him, and because we're not using the same protocol in a public network, right?
Yeah.
So the email will have never been the useful tool that it has become over the years, right?
No doubt. So I think we can evolve into... So hold on. Before we evolve into stablecoins, I kind of want to recapture this conversation here. So what we've heard is there's advantages to tokenizing for collateral and therefore capital efficiency on one side. It's an enormous unlock, and we've certainly seen that there's benefits timestamping that's a lot more than meets the eye. So of those 10 billion, why is there going to be, beyond stablecoins, the next 100 billion or the next $1 trillion? What types of things, Yuval, could be tokenized? And I want to go and get everyone's take on this, that aren't yet, I would say, popularized.
Beyond collateral?
Beyond collateral.
Beyond collateral. So we have last year tokenized 100 private equity funds purely for the operational efficiency of processing. And by the end of this year, we're going to get to about 1,000 private equity funds. And again,
so you're tokenizing what, the LPs or
all the way from the GP issuance of the fund to the LP obligations, the fund administrator, the RIAs, wealth managers, all of the transfers between all of them. But back to Carlos' point, now if all of that exists on a public chain, and now suddenly you have a stable coin on a public chain, there's nothing that prevents you now when you have a capital call or a capital distribution to actually now, instead of saying every time I have a capital distribution, hey, I'm going to send a fax to a bank or I'm going to send an email to a bank, hey, by the way, send these 100 wires. And then what ends up happening, they don't send those 100 wires correctly. By having all of these things on chain, you could really streamline asset classes that today, just a stat, the average major participant that participates in the life of a private equity fund will spend about 3,000 hours of reconciling.
3,000 hours
of reconciling in the life of a private equity fund, every participant.
That's pretty damn expensive.
So as a result of that, for example, if I want to get a loan against a private equity holding, usually banks will tell you to, unless you are worth billions of dollars, and then they're going to go through the headache to verify that
they'll tell you to F off is what you were trying to say.
So if you can bring these things on chain with that efficiency, it creates opportunities that today are just not financially feasible. So there's private equity.
So private equity is one example. Eric, what's another example of something that you think is going to be tokenized in the relative near term that perhaps isn't popularly tokenized yet?
I don't know if it's super near term, but I was even thinking, the next trillion or the next.
Yeah.
It's certainly possible to have whole asset classes that get done at the same time. So I'll give you, U.S. real estate is $50 trillion, right? Now, obviously, if you have building by building, house by house, but that's going to take ages and ages, okay? The UK real estate market is 10 trillion. Now, the difference between the US and the UK is that in the US, you've got sort of state by state, the transfers, it's all very difficult, as anybody who's transferred property in the US knows.
Yeah, the titles alone
title
are
and
a
so
nightmare.
on. In the UK, it's different because you have the UK land registry, where every property is listed. It's a centralized database that the government runs. Let's say, for whatever reason, the government said, okay, well, let's tokenize all the property, and maybe at the edges there'll be opportunities for people to do conveyancing and move the properties. They can use tokens. The owner can claim the token of the property, etc. You would just have, by that simple action, you would say, okay, well, then we've just increased. Now there's 10 trillion of real-world assets that we've added. I'm not sure it necessarily changes the world, but it's something that...
Well, maybe not, but not everything has to change the world or have crypto-type 100x returns. We talked about efficiency here. At the scale of numbers we're talking about, a 20% efficiency is a total unlock moment. Carlos, I'm sure you've been studying this too.
So you're going to give me 2 minutes to make my point. First, what I think is not going to be tokenized is real estate and stuff like that, because it really doesn't add any value. So people confuse tokenization with digitization, and private equity backend is somehow the same problem, right? You don't actually need tokenization, you need a blockchain. What you need is to digitize it so there's no person making mistakes because it's tracked digitally on a database, right? So all those things are, in my opinion, better than the status quo, but not like good examples of what tokenization adds value. Because for tokenization to add value, you need to tokenize something where the token actually allows you to do something else. If it's pure efficiency,
like secondary trading, for example.
Like trading more efficient, which then it leads to whether the asset is actually tradable or not. That's why I'm skeptical about real estate, or by being able to redeem the content of a fund in a more efficient way. I mean, distribution is a good point, which you can just...
Okay, so then what is a good example?
So I think for today, if you think about where crypto is, not forget about TradFi, because I think that will take much longer to penetrate. Where crypto is, the things that resonate with crypto are things that are liquid, yield-bearing, that can be composed on chain.
Liquid, yield-bearing,
like that's why
it can be composed on chain.
Right?
Have you heard of anything like a stablecoin before? Those might be.
Except they're not yield-bearing.
So,
minor point.
Are they?
They're not supposed to be.
They are reward-bearing.
They're reward-bearing.
Correct. So they're bypassing regulations.
Well, we'll get to that in a second. So stablecoins. this is the elephant in the room. We're finally unveiling him. Stablecoins are what, 170 billion, although plus or minus any given day. Right now, it seems a killer use case of a real world asset that has been tokenized and is better, would you agree? Perhaps in some ways than the way digital money has previously existed.
I would agree that it is better in that the speed of transfer is better and the control over that transfer is better. There are still some some concerns about how soundly backed those tokens are versus what people would say are traditional transfers.
So that sounds a little bit less of a technical problem and more of a either reputational problem. Eric, what do you think?
I think there's another issue as well, which is like they're great for transferring value, super useful. They're not money. Like legally, they're not money. It's a technical thing. So if you want to, for example, put somebody into bankruptcy and petition them into bankruptcy, the court will say, well, do they owe you money? If they don't owe you money, if they owe you a paint job on your house or they owe you return of your car or something, will you need to sue for damages? The court needs to say how much money they owe you. When they don't pay you the money, you can petition for bankruptcy. So I guess what I'm saying is, I think some of these use cases that are being considered, so on-chain lending, stuff like that, if you're thinking about it where it's meant to be a recourse product that operates like the way that we would think that typical loans operate.
Doesn't work that way yet, but it sounds to me
like it needs to be money. So there are products. There's Quantos on Algorand is one where they have an EMI license. There's electronic money. That's equivalent. That is money in the legal definition. So I think there's things like that that will evolve in the future and that are quite important as well. Now, obviously, if you're using it, using stablecoins to buy cryptos or that kind of thing, it doesn't really matter because you're exchanging one form of value for another.
True, but also, doesn't it seem like overnight someone could basically bless stablecoins and say this is now money?
Why is no money? Why is no money? Like it meets the definition of money. Money is a unit of exchange, unit of value.
Yuval?
I was going to say that there are already yield-bearing stablecoins, which are tokenized money market funds.
That's not.
That's right. Well, it's essentially
a stable value fund. That's a very.
But my point is, it actually is because what the stablecoin issuers have done, because of regulation, because they're not allowed to create that asset without calling it a security, right? So the only difference between a stablecoin and a tokenized money market fund is that a tokenized money market fund is a security, and a stable coin right now in the US will become a bit more clear soon what it is. But on the back end of it, it's a money market fund.
Well, so far,
correct, but this is
almost always. So like, for example, everyone here knows, I assume, that Tether is one of the most profitable businesses in the world because essentially they captured the yield on they were taking out T-bills, and what they were doing, in fact, they're one of the largest holders of U.S. Treasuries, and they were simply capturing the yield, and then as a service, offering this online tokenized, right, RWA US dollar that could be used on native crypto rails, like Algorand, for example, right?
It's regulatory arbitrage. I mean, of course, the stablecoin issuers could actually get a registered fund that is available for retail, that is on-chain, and that shares the yield in a transparent way, etc. They just don't want to do it because that's friction, and this is why one category is 170 billion and the other one is 5 billion, because one has no friction, permissionless tokens, nobody cares what happens. The other one follows regulations.
Okay, so what has to happen? What's the unlock moment for $170 billion in stablecoins to become $1 trillion, right, in stablecoins? How can we do that?
I think it's regulation. I think it's what everybody's been saying is as long as they're treated like securities, then it's not money. It's anathemic to many crypto native people who don't want to touch securities. And so when the regulations are clarified about what is a stablecoin, is it a security, is it not, can you pay real yield, not rewards, I think that is a big unlock that could happen.
It's very ironic that when the Fed rate comes down, the rewards come down.
Yes, it's been
magically correlated.
But they still are as exciting as ever. I mean, the reality is that stablecoins to this day are basically eating up a lot of the transactions on major layer ones. We're seeing it used sometimes even more than the native token on some of these layer 100%. Ones. It seems like a really great use case today. For all sorts of things, that whether initially it was an off-ramp for risk, It was simply kind of the dollar equivalent. Instead of withdrawing to cash, you could withdraw to a stable coin. It was a lot quicker. But now it's being used for example, international remittances. And this is an RWA.
Trade flows, right? Trade finance, it's being used for escrow.
What percentage of the 170 billion are used for real use cases versus just, trading pairs in crypto or collateral in crypto or crypto native usages? What would you say?
You're asking what percentage?
Yeah, out of the 170 billion, how many of those are used for I send money to Mexico more
What Carlos is
efficiently
saying is that a big part of that number was a deflationary hedge for developing countries failing currencies, which is a big part of Tether's market share.
Is that what you were saying, Carlos?
No, I was saying, for instance, look at PayPal. PayPal has issued a stablecoin, right? And PayPal use case is not to use the stablecoin as a
well, it hasn't been very successful thus far.
But because they're focusing on cross-border payments, which hasn't taken off yet.
So wait, is that really why you think it hasn't taken off?
I don't know.
Because
you can ask Jose here because
well,
it's
no,
the conference.
what I'd ask is...
But my point being is that most of the stablecoin usage is within crypto, for crypto traders, for DeFi protocols, and for the stuff like that. And then if gonna get $1 trillion if crypto goes from $3.5 trillion to $10 trillion. So it's going to be correlated with the size of the crypto economy.
Yeah, I think that it's what Amar said about regulatory clarity, but I think that if stablecoins will offer to do on-chain payments with privacy, you would see a massive spike. Because again, if you have the regulatory
massive spike from whom? From which user set?
From issuers.
Everybody?
Specific issuers that would want to be regulatory friendly. Because again, by definition, stablecoin are more efficient than the existing payment systems and the existing, settlement system. They are just more efficient.
Especially if they're on certain types of blockchains.
I think what'll be super interesting is just if the it's kind of a nice position to be in if you're a circular tether where you sort of say to your holders of your guys, I'd love to pay you some return, but I just can't. It's really tough.
Because you keep everything circular.
Love to help you. Now, let's say that were lifted. I think it puts them in a little bit more of a difficult position because suddenly you get competition in the market. And people can offer some kind of a return on the stables.
Then you're competing with Biddle.
But it's no different.
Wait, gents.
I think that there's the money market funds. I would say Tether's sort of killer thing is that they're integrated everywhere.
Eric,
so distribution.
How much money sits in checking accounts? I just disagree because again, if the regulatory clarity means that they can pass the rewards, it doesn't mean that the assets are going to go down because it's no different than checking accounts. I can promise you there's a lot of money.
Not go down. I just mean if people say, I'm going to be holding 50 million on a stable coin.
They do because
would they say, okay, maybe I'd rather hold the one that pays me a small return, for example, or maybe they would switch into money market
people
funds.
hold I don't know how many trillions of dollars at BNY Mellon, which is where Circle custodies their money. I mean, at the end of the day, all assets in the world have counterparty risk if they're coming from an issuer. There is no real dollar unless you're holding cash or you have an account at the Federal Reserve.
Christian and Carlo would tell you that there's only two types of at least US dollars. One of them is paper and one of them is made out of metal. That's all there is so far.
And when you have money at JP Morgan, you actually don't have US dollar. You have a liability against JP Morgan, and that's why the FDIC exists. Sure. So every asset in the world have counterparty risk. And if stablecoin providers will manage their assets efficiently and will custody with people that you believe you have lower counterparty risk, you will see those.
Okay, so far, let's get back to the point here.
Why is Circle
Carlos,
a trustworthy partner?
Carlos, let's get back to the point here. So far, the killer use case, perhaps for blockchain so far, is a tokenized real-world asset. The reason I mention this again is I started this conversation by talking about what a failure RWAs seem to have been initially, and yet thus far it seems like this one thing that we're talking about, the nuances of, has taken off. People are using stablecoins today, and from what I'm hearing from you guys, they're going to be using them even more tomorrow, perhaps with some regulatory upgrades, maybe some infrastructure upgrades.
I think some infrastructure upgrades as well. I mean, look, I started this out saying that it's a solution looking for a problem. I think stablecoins have identified the problem. The problem is movement of money with speed and efficiency. And where are those problems? Those problems are in something you didn't want to talk about anymore, but collateralization.
There we go.
Right? That is a problem because that marketplace, that space is largely doesn't have standardized technology yet. especially outside of the exchanges, there's no standardized technology, right? And so I think that's where you're seeing the killer use case, because in crypto, which doesn't have a standard, the exchanges have adopted it. And so now, and not only have the exchanges adopted it, but all the OTC derivative traders that are out here have adopted it. And you get real movement. Payments are done with that. And so I think once you have regulatory clarity, all payments could be done with stablecoins. That's the problem that needed to be solved.
I think if you think about where stablecoins are being used today, which is largely crypto, like all these other use cases of real-world problems that stablecoins could solve, like international corridors, etc., they're, in my opinion, very small. It's within the crypto ecosystem, right? So why people are using stablecoins and not using an actual money market fund, a real money market fund where you have transparency about the yield, you receive the yield because you're investing there, like you're investing and Tether keeps the yield instead of giving to you, etc., is because of friction. Because stable coins are permissionless.
So lower friction is a main reason.
Regulatory friction, like anything else that you tokenize that is not a dollar.
It's not a security is what it comes down to.
Yeah.
But Carlos, you mean permissionless specifically, right? It's not sort of it's general. It's
not
the fact that you can transfer it to any.
Because it's not a security, even though it's been
that's the reason.
treated as a security. When you start sharing the yield, you start thinking about it. You're just basically doing regulatory arbitrage, right? Because you basically it's saying it's not security, but you invest on my pool of capital, and I'm going to give you a part of it.
Well, I'll tell you this.
That's
it does seem like there are things called stable coins that you can buy rather permissionlessly on DEXs right now that offer some sort of reward. They look a lot like stable coins.
If the reward is given by the issuer, essentially it's like they're basically taking a pool of capital, they're investing it in treasuries,
so what you're saying
whatever,
is
and they're
you would say those are securities, is your point.
That when they do that, they're getting very, very close to being a security.
Certainly
that's why they don't do it like very publicly.
Certainly by the definition so far, but I don't know if you know this, but in a few days there might be a new administration and a new Congress, and the United States might change its rules.
100%.
Maybe.
So they might get legal and the way they are. And
TBD on that one. We're in interesting times. Okay, I want to hear from you all. Lightning round. What is your prediction for the most exciting development in RWAs in 2025? Eric, we'll start with you. Most exciting development RWAs in 2025?
Well, I thought I'd use the opportunity to say there's going to be staking rewards on Algorand.
marketing plaque.
Okay, that sounds pretty exciting.
Very exciting. Very, very exciting.
Coming this year?
Coming in super shortly, like a week or two.
Most exciting development in 2025?
On-chain collateral management with privacy using both tokenized money market funds and stablecoins.
I can't wait to hear more about that and some of the big names using it. And then I hope next year we're going to talk about how big that market got in year one.
Today we announced it with QCP, but there's more joining soon.
Even better. Carlos?
I think integration of RWAs with DeFi protocols in a legal way to provide real utility to the tokens.
That sounds interesting to me. I'd love to be able to use RWAs as collateral for all sorts of nuanced DeFi. Amar?
I agree with Yuval. It's going to be it's collateralization across the board and the tokenization not just of cash and cash equivalents like bills, but right now hedge funds post equities as collateral. Hedge funds post corporate bonds as collateral. Why wouldn't we tokenize those in order to make the movement of those a little bit faster?
In 2025, including TradFis using it for their TradFi activity, not just for crypto.
Love to hear that. Very bullish. Gentlemen, thank you so much.